Hey there, friend. Welcome back to another edition of the Premier Investments and Wealth Management Financial Program. I'm your host, Doug Wagner, and around the table with me are three gentlemen. Get to them here in a matter of seconds, but I wanted to direct you to premieriwm.com, the website. Just grab your phone, tablet, your laptop, desktop. If you've reworked an Atari so you could get to premieriwm.com, good on you. Go there, click Get Started, and then answer a few questions. What they will do is provide you a one-page Premier Vision document that can serve as your roadmap for a financial future. You probably don't have a financial plan if you're like most people. Maybe you're saving, but are you investing? Because that's really where things start moving. They can help you with more than just the saving and investing as well. I think the financial plan is something that you're going to turn to again and again to help you make daily decisions. PremierIWM.com, click Get Started, or you can call and make your appointment today at 800-383-6590. That's 800-383-6590 for Premier Investments and Wealth Management, named to Forbes 2026 Best in State Wealth Management Teams. Starting in the middle of the room here, wealth advisor with over 31 years of experience in the investment industry, Jonas Everett. How you doing, Jonas?
Great, Doug. I got my Commodore 64 here. I'm looking forward to playing Pong with you all afternoon.
Oregon Trail.
There you go.
That's great. Next to
we
me.
survived, but our whole family died of dysentery.
Exactly.
What a great mood to start a new life in the West.
I saw this one because of this recent cold snap and all the snow that they had. They said everybody is Honda Civic is out there, and they all got stopped at the same time in like a foot and a half of snow. Oh. They all died in their Honda Civic in the Oregon Trail because they couldn't make it to the next gas station.
Did everybody watch The Day After Tomorrow over the weekend?
Welcome to a really uplifting show. Speaking of uplifting, wealth advisor, accredited investment fiduciary, a certified financial planner, professional. That's CFP to you. Over 11 years of experience in the investment industry. He's right here to my right, Dr. Casey Mushrush.
Just you, Doug. Not that kind of doctor.
Uplifting. No, that's good. Hey, I got something over. We're not going to talk about that today. We're going to talk about your financial future with another person who's in the room. He's the president of Premier Investments and Wealth Management. In addition to being a wealth advisor, he's accredited investment fiduciary, AIF, and he's a certified exit planning advisor, CEPA, with over 22 years of experience in the investment industry. We know him as the Big Kahuna. He is Roger Abel. Roger.
Thanks for the intro, Doug.
How are you?
I'm freezing.
Yeah, I know. It's kind of cold in
here. Chilled.
Yeah.
I think the rest of the country is completely chilled or snowed in or iced in, wherever. We were talking about before the show where my girls play tennis on the weekends. Mm-hmm. They have they put these domes up and then they crank in this heat from down below. Yeah. The best thing to do, stand over those for about 2 minutes. It just changes your entire day.
Exactly.
I've been cold since I got out of bed today.
It's funny. You remember this because we used to do these shows in my studios. And one of the reasons you probably moved is because it was unpredictable as to whether it was going to be 56 or 86.
So I would say it'd be 92 degrees in there.
It was 56 this weekend. And so we had to find some workarounds in order to do that include those big maxi fans and little portable heaters plugged in from around the building.
On the weekend.
On the weekend, because they're not going to call anybody on a weekend, which is fine.
So it was 56 degrees.
It was 56. I got in there on...
So wear your hat and gloves and your woolies and all bundled up.
I was all dressed for that this morning, and I walk in, and it was like 68. I'm like, okay, it worked. Yay. So
who'd you interview that morning? Yukon Cornelius?
Exactly. You know what he told me? Bumbles bounce.
It's already off the rails. 5 minutes in.
I know.
On Yukon.
But you know what? People love this because they get to see that we're like real people. And the whole point of this is that they are not trying to sell you anything. This is the way they are. They care about your financial future, but they care about you as well. Roger, Mia's got a question. My husband and I are in our late 30s, both have government jobs with pensions. I'm nervous about having all of our eggs in one basket. That realistically is out of our control and could change at any time. At the same time, since a chunk of our paycheck already goes to the pension, pulling another chunk into other savings vehicles feels like we're sacrificing lifestyle along the way to potentially oversave. How do you recommend people with pensions plan for retirement? This is really interesting about this because, well, help me understand this.
I think it's actually a very mature way to go about a pension.
Mm-hmm.
And what Mia is really asking is, should I be planning for the worst?
Okay.
The planning for the worst is the pension is gone.
Right.
Or not in the same fashion that they assume it to be. And probably part of the reason is if you look at pension plans over the course of the last 15 to 20 years, many have been underfunded. Many have had to lower payments to keep them solvent. So it's a fair question to ask yourself. I think when I think of a pension, it's not a plan. Pension's not a plan. It's an income source. So it's a part of the overall plan. And one of the things to start thinking about is, do you want all of your income from one source, or would you rather have it from multiple different sources? And that's where you start to think about, how do we start saving on our own so this pension is now less of our overall income plan, but still a part of it. And what I mean by that is, Mia said, hey, I feel like I'm sacrificing lifestyle to put other places. Well, what you're really doing is protecting your lifestyle long term. Mm-hmm. You're saying, I'm going to give up a portion of my income to take personal responsibility for my savings. And if this pension plan doesn't work out, no big deal. But if it does, guess what? You're either going to have a pile of money you can do something else with, or you're going to have an enhanced retirement and be able to do more things. But I think this is a really mature way to think about it. It's really how we talk about Social Security with our clients who are under 40. Most of the clients under 40, they don't even know what their Social Security benefit is. Mm-hmm. So if you plan on not having it, what's the worst thing that's going to happen? You're going to get some gravy when you retire.
Yeah.
And I am not on the show telling people Social Security is going away. Mm-hmm. I'm just saying, look, if you plan on not having it and you're 35 years old, it can only get better from there. Mm-hmm. And that's how I do it for myself. I don't ever take Social Security into the equation. I believe it'll be there. I'll get something. Will it be like it is today? Likely not. There'll be something different about it, but it's not going away. I had the conversation with somebody in my office the other day. Well, maybe we should take Social Security right now because it might not be there. I said, you really think that the government is going to pull back and completely eliminate the only retirement plan for 75% of the people in America? Mm-hmm. That's going to be a bigger problem. Mm-hmm. No one has any money. That's a bigger problem. So diversifying income sources. So now for Mia, we have Social Security, we have a pension, add in a Roth IRA, add in a non-retirement account. You know, you don't have to save it in a retirement account. She could put it into a non-retirement brokerage account that they could use for other things, not just retirement. So diversification of income is important as we get closer to retirement. I think the best thing that Mia can do is sit down with an advisor, run a plan, and just assume you're going to get half of that pension benefit and figure out what you need to be saving to be on track to accomplish all your goals and all the things that you want to do in the future.
I'm not as smart as I look, Casey, so you're going to have to help me with this one. Just set you up for that one. I thought the whole concept of a pension is that the employee didn't have any part of it. It was something that the company, in this case, the government's pushing money into.
So yes and no. It depends on the way that the pension is structured. Okay. So there's some state pensions where they still take a portion of the employee paycheck. So they will contribute a portion, and then the government will actually contribute a larger portion.
Okay.
And so there are some automated provisions that actually occur even over in some of these public pensions that are out there. One thing I think is kind of interesting on this too, Roger, and you mentioned this a little bit when you were talking about Social Security, is sometimes we actually see some of this stuff happen in the opposite. So here not too long ago, there were some changes to Social Security claiming with windfall elimination and then also the government pension offset, that those actually improved people's ability to take Social Security while receiving some of the government pensions that were making contributions that would not have otherwise qualified for. So that's actually something that relatively happened here, where there's going to be certain government workers that actually have more income than maybe what they were necessarily planning on. Now, I'm not saying build your plan, as you mentioned, on the best case or the rosy scenario on things that we don't know is going to happen over in future legislation. I agree with you, particularly the further out that you are, the more uncertainty that there is. You want to be a little bit more cautious, particularly in building up your savings and building out your long-term mechanisms for creating future income. But sometimes these things, they can shift and they can actually end up being better than maybe what you were expecting.
Jonas, I real quick want to ask you a question, because the idea is, like she says, can we oversave? Is there such a thing as oversaving?
I don't think so. I think it's a built-in track record of having the habit, and I just think it's a personality trait.
Mm-hmm.
So
Okay.
as long as people are comfortable with saving, they can save at any point in their life.
Yeah.
I think that we do a good job in helping people, working with them on enjoying their money, kind of the money out later phase, and getting people started too. That's a lot of fun.
Yep, that's good. And that's, I like that. I like the way that you explain that. So they're in their late 30s, doing a good job. It sounds like that. Just keep up the good work and get in touch with my friends at Premier Investments and Wealth Management. If you have questions like that, they'd be happy to talk to you and answer you. 800-383-6590. Jonas, for you from Tim, we will be getting a larger than expected tax refund this year and are debating what to do with it. We've narrowed it down to paying down our mortgage or contributing to Roth IRAs for each of us. What would you do?
You just made my day, Tim. I love this because you're treating your tax refund, instead of buying a entertainment system for your man cave, you're treating it as a spare tire. You're treating it as an actual bucket for your personal finances, and you're making a financial plan out of it. The answer is neither option is automatically better. I would probably consider for you to do both, just as getting more information on what a mortgage payment, what an extra mortgage payment is going to do, what a Roth IRA contribution, a new one, is going to do for you. A mortgage payment, obviously, it's going to reduce your interest that you're paying over time. At some point, if you continue to make extra mortgage payments, your payments are going to stop a lot sooner. That's important for people because it makes them feel better to make extra mortgage payments now. However, the money is gone forever. If you make that mortgage payment, and we go back and forth on what homes are homes a place to live, or are they a good investment? So we have that debate. Now, if Tim does a portion of that, maybe half in a Roth IRA, that's an after-tax contribution to an IRA account called a Roth. Ultimately, that has to have a time frame, Doug, for his retirement. So I'm not sure what his age is, but that has to be earmarked for retirement. And that's going to provide a little bit more flexibility, because Tim would be able to get his contributions back at some point if he were to get into a pickle. But Tim, to answer your question, it's not an all or nothing investment with your tax refund, putting it towards the mortgage or starting a Roth IRA. I think it's a great job earmarking that amount. One of the things that you have to consider too is don't stop there with just earmarking your tax refund each year to put in to help your finances. Let's go ahead and look at doing a financial plan where we can automate things. Mm-hmm. And maybe Tim could go into his personal finances and we could do something on a monthly basis, automated. So imagine, Doug, he's putting half of his tax refund into the mortgage, mm-hmm. putting half into a Roth IRA contribution, and we're doing that automatically on a monthly basis.
Yeah.
That's going to be fantastic for Tim as well. But great idea. At least this isn't going for a motorcycle or something like that. He's not using the tax refund for something
frivolous.
Bad. Yeah, absolutely.
I'm at the bar. First 2 rounds are in me. Well, okay, maybe the first round.
See you there on the 18th.
Okay. Here's another thing, too, is like, say, for example, his house, maybe they are one of these people who are locked into a low mortgage rate, and they're not interested in selling because if they sell out now, then they're going to get into a higher mortgage rate. there's things you can do around the house that can actually enhance the value of your home over time. Would that be something reasonable to take a look at too?
There are so many pros and cons. In the Everett situation, Everett household, we got in a big hurry to pay our mortgage off. And lo and behold, I missed 2 years of one of the best bull markets in the history of the S&P 500.
Yeah.
But it does feel better making extra mortgage payments. So back to working with an advisor and a financial plan, a lot of it isn't the best investment. And a lot of it is what makes you feel better.
Right. Makes sense to get in touch with my friends at Premier Investments and Wealth Management at premieriwm.com. Doesn't matter whether you click Get Started or you go through and just make an appointment with one of the folks. You can even do it by calling 800-383-6590. The point is, what you're doing is you're wanting to make sure that you get that one-page Premier Vision document to help you map your cash flow, to help you set your goals, to create a path to those goals and your priorities. It's all in one place, and it's only one page. There's a lot more pages behind it, but it's one page. You get a free, no-obligation consultation. Take that with you. And I think that the big thing is that utilizing the professional resources they have at Premier Investments and Wealth Management to make sure that you're moving forward in your investments. Also, don't forget, they have a whole suite, the Investor's Guide series, it's called, at premieriwm.com. In this case, you can take a look at the Rothification and your retirement portion of it and download the rest of them as well. Any questions, again, 800-383-6590, Premier Investments and Wealth Management, named to Forbes 2026 Best in State Wealth Management Team. For you, Dr. Mushrush, from Reggie.
Just you, Doug.
Yes, sir. My wife and I are retired. We own an investment property. The house is in a trust that will eventually go to our 2 sons. One of my sons wants to live there with his new wife as they start their family, but they can't afford the standard rent. I'm torn between charging him below fair market rent or charging full rent and gifting him the difference. How do I evaluate the tax, retirement, and family implications of each option?
Reggie, this is a fantastic question and not something that is uncommon, actually, especially when you start to get over into families where there may be an additional real estate piece of property or something along those lines that comes over into the situation. Oftentimes what we see is people really want to help their kids. They want to put them into the best position that they can be. And it sounds like that's exactly what you're talking about. And so I want to just point out that is an admirable thing. Now, the challenge with that is that this is a very, very complicated question when you get down to it. And really, whether you do the below fair market value rent or if you charge and do the gifting, neither one of those automatically is the best. It's going to take a little bit of additional information before we would actually be able to make that determination. So I'm going to start this off on the front and saying we're going to talk about some different situations and some different things to think about. We will not have a cut and dried answer for you by the end of this because once again, Doug, as you know, it depends. So first, let's talk about if you were to charge below market rent. So when we look over at a below market rent type situation, if they were to move in, there's a couple of issues that may come into effect on that. Because you're under fair market rent and you're also renting to a family member, it may actually change the nature of that rental property itself. It may no longer be an investment property. It might actually just be a personal property that you are receiving some level of compensation for, or some level of gifting actually back over to yourself, essentially. Now, the challenge on that is if you are holding it as an actual investment, you lose out depreciation, you lose out some of the other advantages of actually being able to own that piece of property, but you are providing that to your child in a way that allows them to actually be able to continue to live and hopefully grow and save. Now, one thing that I do have a concern on here, you already mentioned they can't afford fair market value on the rent. So that does probably suggest that without some level of gifting somewhere along the way, they're probably not going to be able to stay in this particular property in and of itself.
So you just can't, Casey, go, you pay $750.
You can, but because it is a family member, the IRS will come in and undo it.
Oh, okay then. All right then.
It will work. It will work as long as you are not audited.
Objection
I suppose.
overruled.
So that's ultimate. You can do whatever you want, whether or not it holds up under scrutiny is a completely different conversation. If you look at the, actually signing a rental agreement, having them charge rent, and then actually gifting back over to them from a purely legal standpoint, this is probably going to be a little bit more appropriate because you can actually get a little bit of additional protection over into place by having that lease agreement, that full market rent. You're not going to run into any of the issues when it comes over to some of the different gifting, at least over as far as the value of that deduction. But you will run into some of the gifting issues on the amount that you are giving them. So, for example, you mentioned that this is over inside of a trust. Now, again, I've mentioned this before. You didn't say what kind of a trust it is. I'm going to assume it's a revocable trust, either under your name, your wife's name, or both of your names. Now, if it's under both of your names, then you guys would be able to gift split because we basically look through that trust arrangement. You guys could give them up to, call it about $40,000 a year without really any significant issues when it comes to the overall gifting standpoint. So that may be a little bit of a better option in this particular instance. However, one thing you kind of hinted at here, and that's going to be a really major consideration, is what are the family dynamics going to look like when you and your wife, or you or your wife, or you or your son walk out of life? What does that look like if something were to happen to any of you guys? You mentioned in this particular instance that this is a trust that's leaving this house to my two kids, or at least the trust beneficiaries. It sounds like the ultimate beneficiaries are the two kids. Is this the only asset that's in that trust? Because if this is the only asset that's in the trust and you're only giving half of it to one kid and the other half to the other kid, are they now going to be paying rent for the other half? Are they going to be expected to purchase that out? Well, if they can't afford it right now, are they going to be able to afford that in the future? There's a lot of other things that need to be considered, rather than we want to do this really wonderful, nice thing for our kids. Now, I'm not saying don't do a wonderful, nice thing for our kids, but it does mean that maybe you guys need to revisit your trust documents and say, if something happens to us, this property that this kid is living in, that is going to go to that kid. And we're going to equalize, or we're going to make it fair with other assets that we own that are either within the trust or maybe even outside of the trust as far as distributing or moving property around to other survivors.
And I'm going to invoke Jonas's name in this before we move to the next question, because it's one of those things where if you have a family situation, one of the good things that the folks at Premier Investments and Wealth Management they're good at doing is that sometimes you need a bad guy in the family. And Jonas has said, hey, sometimes we have to be the bad guy, and we're the ones help that. It helps to have a financial professional that has an understanding of this. And yeah, it's time for you to get in touch with somebody who can help better quantify and qualify exactly what you're looking for, because, Reggie, that is complicated as all get out. Premier Investments and Wealth Management at premieriwm.com, named Forbes 2026 Best in State Wealth Management Teams. Jonas, I'm going to go to you with this question for everybody. It's from Sam. We're going to start with you. I saw a statistic online the other day that the minimum wage someone would need to make today is $66 an hour to have the same purchasing power as someone in the 1970s. Don't know if that's true, but I know wages haven't kept up with inflation in most industries most years. How do you advise younger investors, I'm 26, to balance the reality of our current income with the need to save for our future?
Really, Sam, great question. You don't need perfect conditions at age 26. A couple of cliches, old financial cliches come to mind. Time is on your side, Sam. So we talked about in earlier shows, I think, how we all started at $25 a month in a mutual fund contribution. And I would really look at paying yourself first. I ran into an old friend. He retired at 59, and I said, how in the heck did you retire before I did? I'm 54. And he said, just tell your customers, just tell the young people to put 10% in. So another cliche, another word of advice is start with 10%. Another cliche I just made up with while we're doing the show, automate to be financially great.
There's four.
Always,
He
dude.
hit for the
There's always
cycle with that
something.
one.
Dude, I don't even need to answer.
I know.
Yeah.
That's it.
So
Don't-
let's go
Thank you very
1%.
much.
Let's go 1% more on top of that 10%. You'll be just fine, Sam.
That's great. We're done with the show now. No, I'm kidding. Roger, at this point, it's something where somebody's so young. I mean, does it even pay to look backwards like that? Or is it just discouragement and say, hey, let's start here and move forward?
Well, first off, I don't know if that's accurate or not.
Yeah.
So I always admit when I don't know. But here's what I would tell Sam. What the purchasing power was then versus now, truth be told, is totally irrelevant to your situation.
Mm-hmm.
It's kind of like if people come in here and they say, you know, I made this investment mistake or I did this in the past. I'm like, well, that's over. Let's figure out the path forward, do the best job we can. And I think Jonas hit on the 4 things you just made up. But, you know, I think the biggest thing here is just a process of saving and get started early. And Sam's already thinking about it. And most individuals and clients I know that started at age 26 and are consistent with it throughout a long period of time, they're really, really successful. Now, fortunately, I started doing this in 2002. I'm now to the point where I have people that open accounts with me in 2002. So we're 23 years later, almost 24. They look at me and they're like, man, that was the best $50 I ever spent. They've started with a Roth with $50 and then they increased it because, you know, I was 23. I was soliciting all my friends and family and people I knew to start a Roth IRA. And now they're like, man, that's actually something now. And it's kind of fun to watch that. But most people that start when they're 26 that are regular, consistent, they're going to turn out to be great. It doesn't really matter what you used to be able to buy with your wage. You don't know. Your job over the next 10 years could become massive demand.
Yeah.
And your pay could triple. Now, that's kind of the thing about the economy. We don't really know where it's going. Typically, it keeps going up, but we don't know what sectors are going to be in massive demand in 10 years.
Yeah, exactly. Casey, your thoughts on what Sam's
Yeah,
talking
I'm just curious where the statistic came from. So, because I did go look a couple things up on there.
I tried Googling.
Minimum wage in 1970 was $1.45. Well, if we go to an inflation-adjusted wage over to the end of 2025, that would equate about $12.36 an hour as it is right now. Now, that being said, that's not median. Median wage in 1970 was for an individual was $4,550, not inflation-adjusted, and that's based off census data. If you adjust that for inflation, it's about $39,000 into 2025. We're about $19.50 an hour.
Well, here, what he's really referring to, I think, is the purchasing power.
Right.
And the cost of things getting more expensive. If you look back to what he quote the 70s, 50s, 60s, 70s, leave it to Beaver, right? Dad went to work, mom stayed at home, and you were able to make everything work on a one-income household because goods were affordable. Well, today, when people look at a house, it's not a house. They don't buy a house that they can get by on one income. They need to have a new one with granite countertops and fancy tile, and just everything has to be the best. And that's why affordability is what it is for a lot of people. Right. Let's be honest. You drive around this town, there's a bunch of homes that are 1,100 to 1,500 square feet. And if you went to most people today and said, well, that's not a big enough house. Well, how was it big enough 50 years ago? But it's not big enough today. Families were bigger 50 years ago.
They were.
And they figured out how to do it. But today, well, we got to have at least 2,000 on the main floor, and we have to have 1,800 in the basement. We have to spend 700,000. No, you don't. And that's why wages, that's why there's an affordability problem, because of people's expectations.
Gotcha.
Yeah, the standard of living is significantly higher nowadays than it was back at that same time frame. Back in 1970 or over at this time frame that we're looking at, how many people had cell phones?
Cell phones, no subscriptions.
Exactly.
Computers,
go
like
look at
anything.
somebody's cell phone bill.
Yeah.
For a family of we have 5 people in our family, the cell phone bill is out of control. And I have 2 kids that don't have a cell phone. But we have 4 iPads, we have 4 iWatches, 2 phones, we have a hotspot. It's $500 a month.
Yep.
Yeah, it's funny because I'm one of the last people within my organization who has their cell phone paid for by the company. That's not an engineer. And so they said, hey, we're going to pull the plug on those things. And I'm like, what?
You're right down the pipe, bud.
No.
I had this conversation with a buddy of mine, the most frugal friend of mine I know.
Yeah.
I'm like, what's your cell phone? He's like, it's like $170. And he's as frugal as they get. I'm like, whoa. Because he has an iPhone, iPad, and a watch. You put them, it's like $10 device fee and then all the other stuff.
Do everything on my phone.
Well, I think
Jonas.
Sam at 26, just like Roger and Casey and Doug is saying, stay in the area of control with your personal finances.
Yep.
Just basically do whatever you can at 26. And just remember Roger's story, $25 a month into a checking account. We don't care what it is. It doesn't have to be a fantastic investment. Just start, and then you build confidence, and then you look at the balance and you get happy with the balance and you want to do more. And then you reach a point where it does crunch your personal income a little bit.
Yeah.
And it's an equilibrium, but at least you started.
Right, and Roger was talking about doing that before, again, where it felt it hurt a little bit, so he pulled back. So it's like you know where that is. But you know what? You're never too young to have a financial plan, and that's where my friends at Premier Investments and Wealth Management can help you, because you've got really good intentions. But when you have the professionals there to help ask the questions about the things that you might, oh, yeah, I completely forgot about that, or that really happens, they're the ones that can help you divine those sorts of things, pull them out into the open so that you can answer those tough questions and prepare for a financial future at 26, that at 76, you're going to say, man, that was the best $50 I ever spent.
I thought about something you just said. You were talking about how I saved on a weekly basis. And I always thought about this. If I oversave and I get to a point where I can't afford it, the worst thing that's going to happen is I have to take some money out of the savings account.
Yeah.
If you overspend and buy something you can't afford, that's a big problem. But how many people think about that from saving? Well, what if I oversave? They don't think about that. Well, the worst thing that happens is you have the money there to go get it. And that's how I approached it. And that's why I got aggressive with it. And if I wouldn't have done it, guess what? I'd be like the other 50% of America that doesn't have anything saved.
Yeah. And right now, especially because if you overspend and you can't afford things, there's somebody out there who's really happy to charge you 27 to 32% on a credit card in order to do that. So try to avoid it. Get in touch with my friends at Premier Investments and Wealth Management, premieriwm.com. Click Get Started. Answer a couple of questions. They'll provide a one-page Premier Vision document, and that is the foundational document for your financial plan. They'll give it to you, free, no obligation consultation. They'll sit down with you where you are. You can come to them. They'll do it over the internet, whatever you want. But get that for free, and you can keep that, and you can start your relationship with Premier Investments and Wealth Management. Or call 800-383-6590. Make your appointment today at 800-383-6590 with Premier Investments and Wealth Management, named to Forbes 2026 Best in State Wealth Management Teams. For Roger, question from Mitchell. My wife and I are 37. She's a stay-at-home mom. In the past, we've always maxed out Roths for each of us, but with some added surprise expenses the past year, we only got about $8,000 left to contribute for the 2025 tax year. My question is, should we split that equally into each of our Roths or focus on maxing off the Roth for my wife first, since she doesn't have a 401k like I do?
I get this question a lot, actually.
Okay.
Pretty common. I would tell Mitchell, there's not a universal rule for how to handle this. At the end of the day, it really depends upon how you think about retirement. If because your spouse doesn't have 401k, you want her to feel like she's contributing from a retirement standpoint, put it all in there. It's really less about whose account it goes into and more about how does it all work together. There's not necessarily lots of benefits to putting in one person or the other. The only reason there may be a benefit to do one person over the other if one person is significantly older. And why I say that, if you have one person that's older, like by 5, 6, 7, 8 years, it might make sense to put it into theirs only because you get access earlier to it if you need it.
Okay.
And there's no RMDs on it, so it doesn't really hurt that situation. I had a family that I work with that there was about a 15-year age gap between wife and husband. Husband's 15 years older, maybe even a little bit more.
Wow.
And they had kids. So they were utilizing And back up, they had a couple of pensions, so they don't really need any of this retirement money. They were utilizing his Roth IRA as the college funding vehicle instead of doing a 529 because they didn't want to be subject to taxes and penalties if it wasn't used for college. So in this situation, we would have funneled to the oldest person. In my household, if we had this situation, I would put in my wife. She's a year older than me. I just put it there only because we're not losing anything and we would get access 1 year earlier. But I think it's more about just making sure everything's coordinating together.
What about, because it sort of feels like he's saying, we got off track. I mean, this is something where we just didn't hit the mark that we were looking to.
I think if you got off track and you're still maxing out one Roth IRA, you're doing pretty good. I mean, you're 37. You've told me you've been maxing out your Roth IRAs and had unexpected expenses. This is the mature thing to do is not take debt to fund a Roth IRA because that's probably the other option, right? Like, oh, we'll put this on a credit card because we want to max out a Roth IRA. That's not worth it. So I would be less concerned about that. I mean, really, none of this is concerning.
Yeah.
You had something happen. You needed the extra funds, so you only max a Roth IRA once. That's not going to determine whether you are successful or not in retirement. One thing Mitchell could do to maybe make this pile of money they're saving for these Roth IRAs less susceptible to this is just automate it. Start doing a monthly ACH, because what happens when you save up a pile of money, you're like, well, I always have this. It's easy to dig into that piggy bank for the emergency. So maybe they just start automating this. So we have a monthly ACH going in, and it's not as easy to say, well, the furnace went out. We'll just go take it from the money we're going to put in our Roth.
Yeah.
I'm curious what the surprise expenses. How much of a surprise were the surprise expenses?
Well,
that's exactly where you're kind of going on that. And,
was this a surprise expense? We need more tile for the bathroom,
right? So
because sometimes
that's what
happens.
There were some significant headwinds. I mean, maybe something happened here, some economic headwinds. Maybe there was something that happened.
Well, that's the point. Is a surprise really a surprise or not?
Yeah.
Because if the surprise is a surprise, if it's a one-time event type thing, then they're probably going to be back on track over this next year. But I think another thing for them, Mitchell, for you to take a look at those surprise expenses and say, is this actually a surprise? And is this likely to happen again next year? Because if it's likely to happen again next year, you might need to start planning for that right now to get yourself back to that savings place where you feel a little bit more comfortable with it.
The financial plan is critical. And Jonas, I'm going to hit you up with two of these real quick because we're going to go to you for the next question.
Sure.
Number one, you got to automate to be great.
Financially great.
That's an Apollo creed. You got to automate to be great.
Financially great, Doug.
Oh, okay. I'm gonna re-implement.
You're
that
already
one.
great.
But then the other one is making sure that you have spare tires, and that's something that you really push. And with the financial plan from Premier Investments and Wealth Management, that's one of the things that you encourage people is to have not only the emergency fund, but other spare tires in case you hit something like this.
Yeah, or buckets, Mitchell. So if you had this situation where you had something came up, and you actually had a spare tire or some emergency savings, so you could go ahead and max out your Roth IRA for 2025. You actually had a spare tire built up. But kudos to you to go ahead and make your contributions. Like Roger said, half of Americans, they don't do it.
Okay. Moving to you for the next question, Jonas. Dan says, one of my coworkers is retiring next month. He said he's leaving his 401k where it is. I always thought you had to roll it into an IRA when you retire. Is leaving it an option, and are there benefits to doing that?
Leaving a 401k there is an option. It's usually for people, in my opinion, that don't have a retirement strategy.
Okay.
But there's some advantages of leaving a 401k, and we have people that come in with old 401ks all the time because they just don't know what to do with them. If it's allowed, a lot of times you have plan level pricing, which is lower because you're using an institution.
Yeah.
And sometimes you have, if you need a withdrawal out of the 401k, sometimes it's more flexible. You can do it at different ages that you can't do out of an IRA, especially when it comes to lump sums. Now, why people usually roll over their 401ks after they retire. They have more investment choices. They want to consolidate. They want to get a handle on everything after they do a financial and retirement strategy. I think that we're really the good guys when it comes to flexible withdrawals. People want the money out people to work with, and we're the money out people to work with. So flexible withdrawals and IRAs. Sometimes you can compare the cost to the service that you're getting. I always use the example. I talked to one customer. He had an institution managing his account, and they would call him once a year, and he felt like that they were trying to sell him something. And I said, well, Great Clips sells hats. They don't charge you much, but they don't do a lot for you. So you need to compare the cost of what you're spending for management and working with an advisor for what you're getting out of it in service and relationship. So great question. You can leave it there. I would recommend that people, obviously, if you're going into retirement, do some kind of plan first.
I have a comment to this, and I get asked this a lot. Why would I not leave my 401k? And a lot of the options that you have in a 401k are the same options you can get with a professional money manager, right? Here's the one thing you won't find in most 401ks: a lot of really great options to generate income. And let's just think about why. 90+% of people doing a 401k are likely in the accumulation phase. They're not in the decumulation phase. They're not getting ready to take distributions. Those options are designed for growth. Yeah, there's a bond option in there. Typically, they might have an income option. How many 401ks do you see that have a dividend paying option? Not many. One that's designed just for income? Not many. That's one of the things you get when you work with an advisor that has a distribution plan. You can start to match different type of investment products to the income someone's trying to generate that you can't necessarily do inside of that 401k. And you know what? If you're never going to take a distribution from it till RMD, whatever. But if you're going to have distributions, you're going to need some fine tuning to make sure your goals and priorities are matched by the account that you have.
And by the way, Dan, I love Great Clips. They do a great job.
I was going to say,
I don't
why does
ever,
Dan like Great Clips?
I don't want to ever meet Great Clips' attorney.
Jerry would not be happy with
They do
you
a
right
fantastic job.
What's Great
Clips?
Great Clips where Doug gets his haircut.
Joking.
So what I do find kind of interesting on that too is there are sometimes where we may generate an income strategy that actually asks you to leave money inside of a 401k plan. So take, for example, if we are trying to take advantage of a rule of 55, if those plan provisions are actually available and we've got somebody who's retiring at age 56 or 57 or 58, and we're trying to bridge some of that income gap to age 59 and a half, we may intentionally leave money in the old 401k plan because we're trying to work around some of those distribution strategies to avoid that early distribution penalty.
I did this with a client. They retired at an employer here in town. He was 57 years old. We did a bucket strategy for him, figured out how much money he was going to need the next 3 years. We allocated it all to fixed income at the 401k. He pulled those 3 years, and then all the rest of the money was moved over here to manage for growth. And then once he was out of his 3 years, he started pulling it right here. But that is a good point where you might want to leave some money in that 401k. Now, be careful. Some employers make you take it all as one big distribution. There's an employer in town that if you want to do a rule of 55, you have to take all the money one time.
Oh.
One big distribution. So that doesn't always work.
It's not tax advantageous.
Well, no,
Correct.
I mean, it's if you're looking at it over the course of a year, I mean, it's the same thing, whether you do it monthly or whether you do it.
Oh, no. This employer, the full amount you wanted to take had to be taken.
Oh, like
one
so
time.
if you want to do all 3 years, it's all 3 years.
One time.
Okay. Yeah. But what you're saying, like if you could do that once a year over on that, whether it's one time a year or 12 times a year, so the tax consequences don't change if it's the same dollar amount over that 12 months.
Last question for you is because you've got the next question, but the last question, this one for you, is there a legal requirement as to how long you can leave that 401k at the old employer?
You can leave it there until essentially you pass away. There's no legal requirement that says you have to pull the money out. That being said, you will be subject to minimum required distributions, not required minimum distributions, minimum required distributions.
MRDs.
Subject to the plan balances beginning when you when
All right.
you hit the appropriate ages.
Okay, gotcha. I knew you'd know the answer to that question because he's Dr. Casey Mushrush.
Just to you, Doug.
Kim wants to know, my husband and I are in our 60s. This is a second marriage for both of us. I have 2 adult kids. He has 3. We've combined our finances and are taking retirement withdrawals in a way that it manages taxes. And that happens to have us drawing more from his account first. We're trying to figure out how to fairly split everything between our 5 kids once we're gone. And our initial thought was to make them all equal beneficiaries across all of our accounts. Is that the best way, or are we overlooking potential issues down the road? This is a
great question, Kim. And equal beneficiaries may look fair on paper, but that may not necessarily, particularly in a blended family situation, may not necessarily be the case. So how the accounts are used can be a very, very important factor that we need to take into consideration. The different tax treatment for each one of those different account types, whether it's pre-tax, whether it's post-tax, meaning a Roth account, whether it's non-retirement dollars, all of these will have different tax consequences to the individual beneficiaries themselves. Now, if you throw that on to, in some states, not all, some states that would have inheritance tax for either heirs or non-lineal heirs that would actually receive some of those assets, there may be some additional taxation that would be due depending on who receives those assets, when they receive it, and depending on the family situation that receives those. So it can have an impact. Just going evenly across the line down to everybody may or may not actually result in equal distributions. Individual heirs, meaning if we've got one side of the family that for whatever reason they have higher income compared to the other side of the family, we may want to divide those assets out and leave certain accounts over to the higher income kids compared to maybe the lower income kids that would be a little less tax favorable, to leave some of those pre-tax assets to them. So we may not necessarily want to have the equal division across all the different accounts. Blended families can sometimes have some additional complexity just in terms of the perception. So for example, if all of a sudden dad's assets are all gone, but we're all still split over on mom's assets, and that has not been made clear to everybody beforehand, that could create some issues when mom passes away, because now we've got 2 families that are looking at each other a little bit askance saying, well, hey, you're now taking part of what is mine, even though that was actually the intent that was laid out by the people who own the assets themselves.
So communication's about
Communication
just as important as everything else.
As important, if not more so, particularly in a blended family situation. You don't want to get into a situation where expectations do not match reality.
Yeah. How many times did that happen to us? Yeah.
Well, and that needs to, and that's
another.
true in normal families as well.
Right.
It's when you add this blended family, you're just adding a secondary dynamic to it that can create additional complication that is even beyond just normal family dynamics.
Wait a second, Casey. You're saying that families fight after people pass away?
I'm saying you want to make sure that you are absolutely clear what your wishes are. And that you let them know
Unfortunately,
ahead
we
of time.
settle estates all the time. I had a brother and a sister come in, and I said, are you guys doing okay? Yeah, we get along great. I'm like, you get along great? But I couldn't even believe it, because they're 1 out of 10, 9 out of 10. There's so many family fights. So I think it's really important what you're saying, Casey.
Yeah.
Well, and this kind of goes back over to a conversation we were having a little bit earlier around some of the trust conversation. Maybe in a situation like this, a trust might actually be a good mechanism, because we can set that up for both individuals, and we can actually set up some level of distribution mechanisms or some level of control from one spouse versus the other. So blended family dynamics may actually result in not necessarily additional tax planning, but it may be just different asset distribution planning that we need to take into consideration as well.
Yeah, this is something that is, a lot of people say, it's common sense. But I'll tell you what, when you're in the midst of a couple of things, you have a blended family, you plug money into the situation, and then you plug mortality into it as that final component. That really can make for some difficult situations. You need professionals who are on your side, who are able to walk you through this, because they've done it for hundreds of clients before you. You have a different situation, but they also have been through this, so they can meld those two and put together a plan just for you that works. Because really, that's what it all comes down to, whether you're investing for the future or you're trying to figure out how to distribute the money to your heirs. It's what they do at Premier Investments in Wealth Management. PremierIWM.com. Call 800-383-6590. Make your appointment either online or over the phone today with Premier Investments in Wealth Management, named to Forbes 2026 Best in State Wealth Management Team. Final question from James, and I love this one because now we get to find out what everybody's little seedy side is, right? James wants to know, what's the one harmless bad financial habit that you have or are okay with your clients having? For example, I always buy pre-cut fruit and vegetables, even though I know it's almost double the cost. It's worth the convenience for me. You're such a bad boy, James. Pre-cut veggies.
No, there's no pre-cut veggies. No way.
That's unacceptable.
this-
Like
I
of all the things, that's
so
like the one
funny.
that's unacceptable.
No, there's no pre-cut veggies. No way. I
Who
can't
wants
do
to
it.
start first?
Who's going to have their
I can
confession?
start on this. So
Yeah.
I mean,
well, no, you have to confess.
yes,
What's
I will
your-
say, like the thing that we do right now, which probably financially doesn't make the most sense, we actually rent all of our ski gear, with the exception of mine. Now, the reason that I do that is, number one, I've got young kids, and we like to go try a lot of different things out, and we can go there, and I do not have to haul it. That is the main reason, is I don't have to go drag all that stuff over through the car more so than anything else. I'm already wrestling 3 kids and a cooler and some other stuff on there. I do not have time to do another set of boots and another set of boots and everything else on that side. So that is my bad financial habit that I'm perfectly okay with, and I would highly suggest, especially if you're doing any sort of a destination type thing, get it while you're there.
All right, Jonas, you're next up in the
I
confessional.
confess,
Oh, man.
the Everett family, we go to 5 different grocery stores to get what we have to get. We're very particular about our coffee creamer, our coffee. The dogs have their different eardrops, so we end up going to 5 different grocery stores, which is horrible on
I know.
gas. We
What's in the
usually-
bottom of that
Yeah,
Gatorade
you
Zero?
pick a
That's
lot
There's
of
just-
this
vitamins
stuff, right?
there. I need my, that's
Okay,
one of the
okay,
5. I
yeah,
need to go to National Grocers or New Pioneer Co-op. Maybe that's 6 or 7, but I confess that that's a bad financial habit for the Everetts. We're burning gas, and lo and behold, Roger, we'll stop and get a coffee along the way to these grocery stores.
I'm all for it. All right, here's how I tackle this in my house, because we all do this. We all have things we waste money on, and that's
Yeah.
okay. The way we tackle it is, one, we know we have to save to be successful. So we save it first. If we're saving enough to accomplish the goal of me being, or our family being, financially independent at the date we've specified, that's giving us permission to spend the rest on frivolous stuff, and not everything has to be optimized. We have a boat. It's the worst possible investment you could ever have. It loses money every year. It goes through a bunch of gas.
Yeah.
The expensive insurance, like everything's bad about it. But it's what our family enjoys doing. So we're going to do it because we have put all the other things in place to make that waste of money completely irrelevant in our long-term financial picture. Like, I know, Jonas, you're being conservative. The Everett family loves to go on vacation, right? And I'm going to guess sometimes you fly first class. Am I right? You've been known to.
No, but there's a
No,
six-
that's
there's
not
a-
true.
We do not. We do not. But
Yeah.
there's a 6-foot mouse in Central Florida that's taking my Roth IRA contribution this year.
But my point is, Jonas, we know each other personally. I know that you've put together the steps to make sure that that's not putting your family in peril.
Right.
So part of why we believe in the financial plan, and this is true, we'll tell this to all of our young people, it's not always to figure out what maximum savings is. Sometimes it's making sure we do the financial plan to give yourself permission to do the other things in life that you have the desire to do and your goals to do and what you enjoy doing without being concerned, man, I hope this isn't hurting my financial freedom in the future.
You know, this actually goes right back to the conversation that we were having, that you were talking about that gal that had the pensions. The young people with the
Mia.
pensions that were saving. Was it Mia?
Yeah, it
I
was
can
Mia.
remember
Yeah,
Mia or something. But this is exactly the thing that she was asking. right? We've got pensions, we're doing the saving. How do we make sure that we know that we're doing the right things? Well, if you put together that plan and you're saving those mechanisms, it doesn't matter what you do with those other dollars.
That's how we look at it. I mean,
It's completely irrelevant if you're not putting yourself into a situation where you're going to wreck your financial future.
here's the problem. Most people haven't actually envisioned what their financial future is.
Right.
They haven't sat down and said, okay, and when we're going to retire isn't the number, because some people don't really want to retire. When do we want to be financially independent? Doesn't mean you can't work, just means I have the option to work if I want to.
I'm going to go to the man who brought us the words on the street is that we're the money out people, and you got to automate to be financially great. The best-selling author wrote something in, I think it was the first of your 2 books, about lifestyle investment and explained that. And that really gets to what we've been talking about is you make a choice in how you spend your money. And you encouraged people to actually put it down on a table.
Yeah, one of my new customers this year, he had an advisor. He came in and he said, I heard the word is on the street that you guys are the paycheck people. You helping people enjoy their money. He said, I like my advisor, but he just wants me to save. I don't want to do that anymore. I want to figure out a way to enjoy my money. So exactly, I took him through a Premier Vision document, and we figured out a way where he could just take the interest and dividends out of his principal, keep the principal intact initially. But yeah, you're exactly right, Doug. At the end of the day, you can't take it with you. You got to enjoy this stuff.
Exactly. And this is the nice thing about it. When you go to Premier Investments in Wealth Management, what they can do is they can help you figure out a way to make your way into the financial future. Go from saving to investing. If you're young, start now. The best $50 that these people did was the one that Roger came to them in the first place. This is critical that you do it because life is too short to have too many open questions. If you can close down those questions, you can nail down those things like Casey said, by answering those questions, checking those boxes, it can give you the peace of mind that you can sleep at night. PremierIWM.com. Click Get Started, answer a few questions. They'll provide a free appointment, and they will show you that Premier Vision document. Next time, I'm going to have one of them sitting out here, a John or Jane Doe one, because we want you to see how simple it is, because they're the ones that take care of the behind-the-scenes stuff. You just give them the guidance. Where do I want to go? Where am I right now? What kind of tools that I have? And they will take care of the rest. PremierIWM.com. Lots of downloadable stuff there. Or you can call and make your appointment today at 800-383-6590 for Premier Investments in Wealth Management, named Forbes 2026 Best in State Wealth Management Teams. For the Big Kahuna, Roger Abel. For Jonas Everett. For Dr. Casey Mushrush.
That's you, Doug.
I'm the Big D, and that don't mean Dallas. Doug Wagner. We'll talk to you again next week.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific, individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Rebalancing a portfolio may cause investors to incur tax liabilities and or transaction costs and does not assure a profit or protect against loss. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Dollar cost averaging involves continuous investment in securities, regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. Contributions to a traditional IRA may be tax deductible in the contribution year, with current income tax due at withdrawal. Withdrawals prior to age 59.5 may result in a 10% IRS penalty tax in addition to current income tax. A Roth IRA offers tax deferral on any earnings in the account. Qualified withdrawals of earnings from the account are tax-free. Withdrawals of earnings prior to age 59.5 or prior to the account being open for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options, each choice offering advantages and disadvantages. Those options include leave the money in their former employer's plan, if permitted, roll over the assets to their new employer's plan, if one is available, and rollovers are permitted, roll over to an IRA, or cash out the account value. Forbes' Best in State Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings, and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firm. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.